Okay, so we have an example, which is the first example as for now. Investors have an expected rate of return of 8%, 0.08, okay, from ordinary shares, which is our equity. I commented last time that the common stock or ordinary shares is same as equity. So you get to understand this and yeah, put this into your mind so that in case sometimes the question is phrased in a different way, they mention common stock, at least you should be fine.
Can't get you, sir.
Oh, okay, thank you. Are you able to hear me now?
Yes, I can hear you.
Okay, so I was saying the ordinary shares, common stock, or equity, they mean the same thing, okay? So in case in questions you find any of these, please just pick them as they mean the same thing. Okay, and so okay, now the equity shares in the algo, which has the beta of 1.2. So the beta is given as 1.2, and the market and the returns on the market or market return, which is RM, is 7%, which is same as 0.07. So the question is, what is the expected rate of return from ordinary shares? So the expected rate of return from ordinary shares, it is called the cost of equity, okay? What is the expected rate of return or the cost of equity, which has the beta of 1.8? Okay. So now, when you look at this, to begin with, you're not given the risk-free rate of return. You're not given the risk-free rate of return. So you need to find the risk-free rate of return. Yeah. So to start with, CAPM shows that you need the risk-free rate of return plus the beta that is given by the risk premium, which is rate from the market minus the rate from the risk-free premium. So we are given the rate of return from the ordinary shares, which is cost of equity, as 8%. So you get 8%, that is should be equal to the risk-free that you don't have, plus the beta 1.2 times the the risk or the return from the market, which is 7%, minus the risk-free rate. So first of all, we are solving for the risk-free rate, which is very, very important. Let's find the risk-free rate for us to use CAPM. We don't have the risk-free rate. So what you are going to do is to FOIL, right? On both sides, you FOIL, you have 1.2 times 7, that gives you 8.4, and 1.2 times the negative risk-free rate, it is 1.2, negative 1.2 risk-free rate. Okay. Then from there, you can now make the risk-free rate the subject of the formula. We're looking for the risk-free rate, which is the subject of the formula. All right. So the risk-free rate, which is the subject of the formula, shall be given as 8 minus 8.4. That should be equal to what? That should be equal to the risk-free minus the 1. Sorry? Yes, madam.
Nasadila, where is the 8 coming from?
It is here
And
in the
8.
question.
4.
The expected rate, the 8.4. You're asking about the 8
Oh,
or
you're
8.
not using the 0.08.
Yeah, we have just, yes, we have not expressed it as a percentage. We have not expressed it as a decimal. It's still the same thing. I said last time, I think someone had asked that question. It should be Mr. Shakasunga who had asked that question last time. So 1.2 risk-free. So you know that this will give you negative 0.4. That should be equal to what? That should be equal to negative 0.2 risk-free rate. And you divide through by negative 0.2, divide through by negative 0.2, so that you can have the risk-free rate that is equal to what? To 2%. Okay. So now it is easy for you to answer the question that says, what is the expected rate of return from an ordinary share, okay, in the other company, Rigel, which has the beta of 1.8? We know that the market gives 7%, which means every company which is operating in this market has got this same rate, right? 7%. But we don't have the risk-free rate for this particular, that pertains to this particular company, especially that they have got their own sensor of risk, which is 1.8, very different from Algo company. So what you do is, from here, you can easily proceed now and find the expected rate of return for ordinary shares, which is same as the cost of equity. So the cost of equity for this one, cost of equity for this other company, shall be given as the risk-free rate plus the beta that we have times the risk premium. And I told you last time that the risk premium is simply the difference between the return from the market and the return from the risk-free investment. So therefore, risk-free rate is given as what? What was our risk-free rate? We found 2%, isn't it? 2 plus the beta of 1.8 multiplied by the risk, the return from the market, 7% minus the risk-free, which is again 2%, right? What is the cost of equity for this company? Hello? What is the cost of equity? You say 2 plus 1.8 times 5. What do you get as the risk, the cost of equity, which is same as the expected rate of return from an ordinary share? It's the same thing. Hello?
That's 19.
19%?
19.
Okay.
Yes.
Is everyone finding the same? Is everyone finding 19%? One point eight times 5 gives 9% plus 2. Is everyone finding the same? 11%. So you say 2 plus 1.8 times 5. Should we be able to get 11%, isn't it? As the cost of equity or the expected rate of return from ordinary shares, it's just the same thing I said last time, and I'm still saying. Any question? Is there any question from anyone?
Sir,
Yes, madam.
sorry, my network was bad. May you repeat from when you started finding the cost of capital? After finding the risk-free rate of 0.2, how did you find cost of capital?
Okay, so we said now we are using
7.
the same formula for the capital asset price model. So we have found the risk-free rate, right? Which is 2%. So you just put 2% plus the beta. Now you are given the beta for this firm as the 1.8. 1.8 times the risk-free rate, the return from the market, 7% minus 2%, which is the risk-free rate. So you have that and you have 11%. You got it?
Yes, sir. Thank you.
Okay. Any question from anyone else? No question, sir. We have understood. Here is another question, which in this case I'll call example.
Sorry to take you back. Sorry to take you
Yes,
back. Was
ma'am.
the answer 11?
Yes, it was 11%. The thing was, you say 2 plus 1.8 times 5.
I was just confirming. Sorry, I was a bit
Okay.
behind.
Okay, thank you. The risk-free rate of return is 7%. The average market return is 11%. What will be the return? What will be the return expected from a share whose beta factor is 0.9? This one you can easily do, right? You're now conversant with the capital asset price model. So the cost of equity, which is same as the expected return from ordinary shares, right? Or from stock, which is the risk-free plus the beta times the return from the market minus the risk-free rate. So you have the risk-free given as 7% plus 0.9 your beta times 11 minus 7%. And what is the cost of equity? Or what is the expected rate of return?
10.6.
Sorry?
10.6%.
10.6%. 10.6%. Is everyone finding the same? 10.6%. Do I have anyone else confirming?
Yes,
Hello.
10.6. That's 7 plus 3.6. That's 10.6.
Okay. All right. So this is the cost of equity, or the expected rate of return from common stock, which is same as the rate of return expected from ordinary shares. It's the same thing. I'm trying to teach you the language used so that you get used. Okay, now. What would be the share's expected value if it is expected to earn an annual dividend of 4.30 with no capital growth? Remember last time I introduced you to the dividend valuation model. So you can easily find the cost of, you can easily find the value, okay? The value of the share, if you are given the cost of what? The cost of equity, isn't it? The cost of equity. If you are given the cost of shares or the cost of ordinary shares, then you're given the growth rate or you are not given the growth rate, and you're given the dividend, the annual dividends, you can easily find the value of the share, right? The expected value of a share shall be given as the price of a share, which is same as the value of the share, dividend given divided by the cost of equity minus the growth rate, right? I think that's what we said last time. And so what is the dividend? The dividend is given as 5 kwacha 13 ngwe. That should be divided by the cost of equity. And we have found the cost of equity as what? What's the cost of equity in decimals?
That was, yeah.
It's 0. What? 0.106. 0.106 minus the growth rate is 0. We are told that the dividends do not have the growth rate, these dividends that we are dealing with right now, as for now. So we'll have 5.5 kwacha 13 ngwe divided by 0.106. And what will be the expected value of a share? The share price. What will be the share price? Sorry?
50 kwacha.
50 kwacha per share. Wow. The share will grow, right? Like, okay. So this is the expected value of a share. If you are given the annual dividend and you're also given the cost of a share, right? Which is same as the cost of common stock, you can easily predict the share prices. And this is what happens in corporations. Some of you who own shares in these corporations, yeah, or those that are interested in owning shares after some time, you will understand that you need this understanding, because of course you have to collect some data for you to be able to start project. Because if you can be able to project the share price, it's easy to know whether you have to invest in that company so that you can get by capital gain or you do not invest. Remember, you can earn in a company or in a PLC, the public limited company, when the shares gain in value. For example, if you bought the share, I'm trying to simplify the concept. If you get a share, how much is the share for Airtel right now? How much do they sell their shares as for today? Or people are not following? You're not following the stock market. But my financial managers, how much is the share for ShopRite, not for ShopRite, for Airtel? We don't know. Okay, it is well. Yeah, when I checked 2 weeks ago, it was around 19. I don't know now. I didn't check today. So let's leave it somewhere at 19. You get shares, 19 quite of course. You get shares in Airtel. Okay. 19 kwacha 1 share. So it simply means if you want how many shares? 100 shares, you just need 1,900. 100 shares in Airtel. So now what it means is that by next year, by next year, maybe, or by the end of this year or somewhere September, you find that the price of a share in the Airtel has increased to 27 kwacha a share, one, right? Then you were just buying the shares at 19 kwacha one, right? One. So you get the difference, right? The difference, 27 minus 19, is what is known as the capital gain, okay? That's that's a gain that you get as an investor. It's called the capital gain. Your capital has gained, which is the equity capital. It has gained because more of value has been attached to the company, thereby pushing the price of the share of that particular company. You okay? Got a question? Is there any question? People are following?
Yes, sir.
Or the side is locked out?
No, we are following.
Okay. Yeah. Let's have another example. You know, the examples that I'm giving you today are not just very straightforward, especially this one. So you have to pay attention and just cement your understanding. Very necessary. Okay, just very necessary to cement your understanding. And now we go on. We move on. The following is an extract from the balance sheet of this PLC, Public Limited Company, all right? As at 28 February 2017. The ordinary shares, okay, of the value of 1 or 0.25, which is 25 ngwe each. The total of the ordinary shares are 250,000, okay, ordinary shares. But each share is 15.5 ngwe. The reserves of this company is 350,000. And there is 7% preference shares of the value 1 kwacha each. And the total of the preference shares is 250,000. So the 15% of unsecured loan stock, which is a debt, is given as 150,000. So the total long-term fund is given as 1 million. Right. So the additional information is given. The ordinary shares are currently quoted at 1 kwacha, right? At 1 kwacha and 25 ngwe each. That's the market price. The loan stock is trading at 85 kwacha per 100, which is same as 0.85. The preference shares at 65 ngwe each, and the ordinary dividends at 10%, at 10 ngwe, which is 0.10 kwacha, has just been paid. Okay, the ordinary dividends of 10 ngwe has just been paid, and the expected growth rate in the dividend is 10%. The corporate tax is at the rate of 30%. The question is, calculate the WACC or compute the weighted average cost of capital for the public limited company. Any idea on how to go about this one? Okay. So what is there is, I said that last time, for you to calculate, for you to compute WACC you need cost of equity, you need the cost of debt, you need the cost of debt. But since we also have preference shares introduced here, you also need the cost of preference shares. Then you need the value of equity, the market value of the debt, which is the loan, the market value of the debt, and you need also the value of the preference shares. Once you find these, then you can easily calculate the weighted average cost of capital. So in short, the capital structure of this company, the capital structure is equity, debt, plus preference shares. It also has the reserves anyways, but we are not factoring in the reserves. We are just talking about the long-term, right? Long-term funds, ordinary shares, preference shares, and the debt, the loan. We start with what do we start with now? Let's start with we already have the value of equity, isn't it? We already have the value of equity. It is given. We have the value of equity. Do we have the value of equity? No, we don't. We have 250, okay? 250,000 ordinary shares. You divide them by this value, 0.25, and that gives you how many ordinary shares? What's the value, the market value itself, the market value of these shares? 250,000 ordinary shares divided by 0.25. What do you get as the market value, as the value of the ordinary shares? What do you get?
10 million.
You get 1 million, right?
10 million.
It's 10 million, not 1 million.
Oh, 1 million. Sorry, 1 million.
Okay. You get 1 million, right? 1 million ordinary shares. 1 million. Now, the question is, how do we find the value? Because we are given that these same shares, they are quoted at 1.1 kwacha 25 ngwe. Okay, that's the quoted price. Quoted price. Not the market price, I'm saying the quoted price. So you can multiply 1 million times 1 kwacha 25. So what will be the market value of the shares?
$1,250,000.
1,250,000. Okay, that is the total market value of the equity. Then we find the cost of equity. The cost of equity now. So which model can we use to find the cost of equity? Here, we talked about two models, right? There is the dividend valuation model that I talked about last time, and the capital asset price model. Can we use the capital asset price model in this question to find the cost of equity? Do we have enough data? Hello? Is it possible to use the capital asset price model, or we need to use the dividend valuation model?
I think we use dividend.
Yes, we need to use the dividend. We don't have the risk-free rate. We don't have the beta. We don't have the returns from the market. For that reason, we cannot manage to use we can't use the capital asset price model. So therefore, we will use the dividend model. So it is given as the dividend model is given as the D0, D0 1 plus the growth rate divided by the P0, which is the value of that share. Yeah, the quoted price plus the growth rate. Okay. Yeah. So what is the expected return? What is the interest that you get from the dividend? It is 10%, isn't it? The question is saying that you get you get the return from the ordinary shares from the dividends, that is 10%.
Yes.
Yes. So then you have 0.10, okay? For DO, we said the D0 denotes the previous shares that have just been paid, right? So the value of the shares that have just been paid, we are told that is 10 ngwe. So you have 0.10, that is D0, times 1 plus the growth rate, which is 10%, 0.10, divided by the market value of the equity of the shares. We are told that the quoted price, of course, which should be, sorry, the quoted price, not the quoted price of the shares, not the market value. A share is 1 kwacha, the share is 1 kwacha 25, right? That's the quoted price for the shares. One share is just 1 kwacha and 25 ngwe, plus the growth rate, which is 1.10. So you have 0.10 times 1.10 divided by 1.25 plus the growth rate, 0.10. What do you get?
Tax?
Like this is equity. We are talking about equity. In equity, we don't pay tax for equity. We pay tax for the debt. Is that fine? We'll factor in the taxes when we find the cost of debt. All right. So what do we have? 0.10 times that divided by 1.25. What do you find? What are we finding? 0.10 times 1.10. Should be 10, isn't it?
0.088.
You have done it together?
Yeah, I'm not meaning to 0.10.
Okay. Divided by 1.25. Or 0.088 plus 0.10. So what is the the cost of equity using the dividend valuation model?
0.188.
0.188. Is it 0.188?
Yeah.
Okay. Where when you multiply by 100, that should give you 18.8%, isn't it? 18.8% as the cost of equity. So I've known the market value of equity. We have found the market value of equity. We have also found the cost of equity. What have we remained with? We need to find the cost of preference shares, right? We need the cost of preference shares. Okay, let's find the cost of preference shares. Keep the values in the head. Cost of preference shares is given as the interest, okay, divided by what? By the price, okay, of the share, the preference share, of course, by the price of the preference share. So the interest you are given is 7%, which is 0.07 divided by, we are told that what is the market, what is the price of the preference shares? Each of them, how much is the preference share? One.
1 kwacha.
Okay, so we are given that each share is 1 kwacha, like the preference share is 1 kwacha. What about the nominal value? That's a real value. What about the nominal value? So the question says the ordinary shares are currently quoted at 1.25 each. The loan stock is trading at 0.85, which is same as the 85 kwacha per 100 nominal. And the preference shares are trading at what? At 0.65, the nominal value, 0.65. So what is the cost of preference shares? What is the cost of preference shares?
0.108.
0.108, okay, which is same as 10.80%. This is the cost of the preference shares, right? Just the cost of preference shares. But the preference shares are already given in terms of their value. What is the market value of the preference shares?
$162,500.
Yes, it is one what? It is 162,500. How did you find it? Maybe someone has a question on how that has been found. Value of preference shares.
So we just multiply from 65 Ingwe, you multiply it by the number of preference shares, which is
Which are how?
250,000.
Okay, is that clear? So that is the market value. So 162,500. So there are 250,000 preference shares, okay, times the value, the trading. It is, each one of them is trading at 65 ngwe. So multiply that, you get the value that we have, the current market value, 162,500. 500 kwacha. That's the value of the preference shares. So I've found the value of the preference shares, very important. Keep the value of the preference shares in the head. What have we remained? We have remained with debt. We need debt. Okay. We also need debt. What are we given about the debt? Let's find the cost of debt first. The cost of debt is given as the interest times 1 minus taxes divided by the price, which is the price of the debt of debt. The price of the debt is a loan stock, right? Which is trading at 85 kwacha. So what is the interest for the debt? this 15%, right? The question is saying that you have 15% unsecured loan stock. So the cost of debt is 15% multiplied by 1 minus taxes. The taxes are 30%, 0.30, divided by the price, which is 0.85. So what is the cost of debt? What is the cost of debt? Twelve point what? 12.35. So you can say 12.4%, right? As the cost of debt, right? As the cost of debt. Confirm the figure. All right. So how do you find now the value of debt? The market value of debt? Hello, what is the market value of debt? You know the cost of debt, right?
Sir,
Ma?
what was the answer on cost of debt? 12 point what?
12.4.
12.4.
Yes, they have given me 12.4.
Okay.
What is the value of debt?
Sorry, sir. So, and I need to understand when they say the loan stock is trading at 85 kwacha per 100 nominal. What's that?
Sorry? Like that's the price. That's the price of it of a stock, a loan stock. Okay, as for now. So this 150 we are finding is the number of the stocks, eh? The number of stocks, but the price, like right now, it's right now nominally. You know, you remember when we were talking about, for example, nominal GDP, what? Like nominal currently. I don't know if that helps.
Okay, so nominal is currently.
It's current. Like right now, right now, it is trading at 85 ngwe. That's one stock, and there are 150 stocks. So what is the value of the debt, the loan stock?
What about per 100 kwacha?
Like this is just an expression of 0.85. You know, when we say it is 85 out of 100, like it's just saying it's 85 out of 100, which is same as 0.85, right?
Okay.
Yes.
Understood.
Okay. So what is the value of the loan stock?
It's 127, 1,275,000, 12 million actually, 12,750,000.
Like this?
Yes. And another 3 zeros.
Do it again.
It's 150.
150. Yes, 150,000 times is 0.85.
0.85. Uh,
127,500. Okay. Like that's the value, the market value of the loan or the debt. Okay. So found the market value of the debt. So this time around, you have you have everything that you need. You have the cost of debt. Sorry?
The 127,500.
Mm-hmm.
How did you find that?
Like the cost of a loan stock is 85 ngwe. Like right now, it is 85 ngwe multiplied by the number of the loan stocks. You have 150 loan stocks. You got that?
Yes.
Okay. So we have everything that we need. Let's write the data on top. What was the cost of equity? If you still remember it. Found the cost of equity. We are just putting the data, then we compute everything. What was the cost of equity?
Was 10.6%.
10.6%. 10.6 cost of equity. Is everyone confirming? You found something like 18. Is it where we found something like 18? Something. Yes, we had found 18. 18.8, isn't it?
18.8.
Yes, we had found 18.8%. Then what's the cost of debt? The cost of debt, we found 12.4. And the cost of preference shares, we found 10.8%. Then now the value of equity, we found 1,250,000. Then the value of the preference shares was given as how much was it? 162,500. And then the value of the debt, we just found it as 127,500. Then well and good. From here, you can easily proceed. We can proceed and find the solutions, right? So let's write. Let's find. So to find the work weighted average cost of capital, it shall be given as the cost of equity times the value of equity plus the cost of what? Cost of preference shares times the value of preference shares plus the cost of debt times the value of debt. All that divided by what? All that divided by the same denominator, which is the value of equity plus the value of what? Preference shares plus the value of what else? Value of equity, preference shares, value of debt. Yes. So let's find. It's easy from here, right? Just to put in numbers. Just compute the numbers that you have already found and dish out the numbers. What is the cost of equity? We said it was 18%, which is 0.188. times the cost of the value of equity was 1,250,000 plus for the cost of preference shares, we said it was 10.8, which is same as 0.108 times the value of preference shares is 162,500. Then plus again, the cost of debt. The cost of debt you said was how much? 12%, 12.4, which is 0.124 times 127,500. All that divided by the sum, right? The value of all these, add the values. Just add the values. Add this one. Let me write in blue. Add this one, the values. This one plus, I'm changing the mark. Okay, this one plus this one plus this one. That's the denominator. That's the value of equity, value of preference shares, plus the value of debt. What do you find as the denominator? Just add together fast, pa. Right. I find, this is what I find. I find 1,540,000. That's what I find when I add that as the total value, the total market value of capital, the total capital. So when you divide everything, what do you find? You should be able to find 17%, 17.4%. You can confirm the figures afterwards. Any question?